Hi there. This video talks about the three different types of receivables: accounts receivable, notes receivable, and other receivables. Then I will explain briefly the journal entries that are related to accounts receivables and take a brief example. So with this in mind, we have the first type of receivables, we call it accounts receivables, which are related to any sales we make it on credit for customers. Then we have notes receivable, which are related to any borrowing and lending cash. And then we have non-trade receivables, which are related to loans we give it to officers or advances to employees or income tax refund. In this presentation, I'm going to talk only about the accounts receivables, and then we talk about the journal entries that are recorded for sales. So whenever we make sales, we usually debit accounts receivable credit sales with the selling price, and then we make another journal for the cost price where we debit cost of goods sold and credit merchandise inventory. If the shipping charges is FOB destination and the seller is going to pay the freight, then he will charge it as debit freight out, credit cash. And if the customer decides to make any returns, we reverse what we have done in sales. So we debit sales returns and allowance, credit accounts receivable, then debit merchandise inventory and credit cost of goods sold. At the end, we collect our cash, and if we decide to collect the cash during the cash period, we debit cash, debit sales discount, and credit accounts receivable. If the customer pays after the discount period, then we debit cash, credit accounts receivable, and we exclude sales discount. So here we have three journals: the one for the sales, the one for the return, and the one for the collection. However, not all the customers who buy on credit, they pay on time. So the company has to create allowance for the doubtful accounts. And here we debit bad debt expense, credit allowance for doubtful accounts. As you can see here on the screen, that the allowance account is contra asset because it goes to the balance sheet by minus in the asset section. Then if the customer decides not to pay for one reason or another, we have to write off the amount by debiting the allowance, credit accounts receivable. If the customer returns back to pay the due amount, then we reverse the write-off journal where we debit accounts receivable, credit allowance, and then we get the cash by debiting cash and credit accounts receivable. So this is in brief the cycle of the journal entries we make it on sales. Let us have a brief exercise to show how we make it. Here we have a company that made sales on January 1st. They received some cash on February 1st. They wrote off the balance on July 1st. And on September 1st, the customer returned back with full payment. So how we make these four journals? First, we debit accounts receivable, credit sales. Then we debit cash, credit accounts receivable. And as we said, if the customer decides not to pay, we need to write off the amount by debiting allowance for doubtful account, credit accounts receivable. And finally, if we receive the amount, first we need to reverse the allowance journal, and then we debit cash, credit accounts receivable. This is in brief the cycle of the journals with a brief exercise. Thank you.